Welcome, everybody. This is Buck Jobby with the Wealth Formula Podcast coming to you from Montecito, California. Today, we want to start with a reminder. We are in a new year and we are already doing deals through the Wealth Formula Accredited Investor Club. You can go and sign up for that for free at wealthformula.com. Just hit Investor Club and you just get on there and you'll get onboarded. And from there, all you got to do is wait for deal flow and webinars coming to your inbox. And, if nothing else, you learn something. So go check it out. Go to wealthformula.com and sign up for Investor Club. Now, on to today's show. This is interesting. I don't know if you are aware, as a listener, but Wealth Formula is probably, I would say, one of the top longest running personal finance podcasts still standing. I've been around, I think the first episode was something like 2014. So it's a long time, but in earnest, at least for over a decade. And, during that time, I've shown up every week, every single week. Don't miss weeks. None. Isn't that incredible? I've shown up, talked about investing and talk about the way markets are working, forces shaping the economy, all that kind of stuff. But, as you can imagine, as a younger individual versus my crusty old self now, a lot of my own thinking has evolved over that time. Back then, and I think this appealed to some people, but I was really dogmatic. I'm a real estate guy, right? And I still am a real estate guy. But back then, I wouldn't give anything else the time of day to even think about, I was dogmatic and didn't always challenge my own belief systems. I'm different now, right? I've softened, and time has a way of changing all of that dogmatic stuff for you. I've lived through multiple market cycles. I've watched the stock market, which I always maligned, melt up to valuations that felt absurd, and then keep going higher. I've seen gold, which was kind of ridiculous for the longest time. I watched it for like a decade, just pretty much flat, and then it goes parabolic over the last year. I've seen interest rates sit near zero for a decade and then snap higher, not even this time, just launch higher at the fastest pace in modern history. And I've learned sometimes, I guess the hard way, that diversification is about survival and that every asset class has its day, just like every dog has its day. And, one other lesson that I learned that I'm thinking a lot about these days is ignore major technological shifts at your own peril. So what am I talking about? Well, it is a technological shift, whether you think it or not, but Bitcoin. Okay, back in 2014, I first started hearing people talk seriously about Bitcoin. And at that time, I dismissed it. I was listening to critics, Peter Schiff, that constantly called it a scam, said it was going to zero, and so on. I didn't take the time to truly understand it, to try to understand it the way I understand it now. That makes me a believer in Bitcoin. And that, of course, was a big mistake, not because, everyone should have bought Bitcoin and back then. Well, it would have been nice if they did. But because fundamentally I ignored something that was a structural change happening right in front of me. And since then, Bitcoin went from a cypherpunk expression of freedom to the large ETF owned by BlackRock. Today, the dominant story is actually artificial intelligence. Now, whether you love stocks, hate stocks, prefer real estate, focus exclusively on whatever, you cannot afford to ignore AI. It's not a fad. It's a general purpose technology, and a technology shift on the scale of electricity, the internet, bigger than the internet, bigger than the Industrial Revolution. Now, that doesn't mean it's easy to invest in. I'm going to go invest in AI and I'm going to make a bunch of money. Because, what does that even mean? It's hard to look at headline names trading at massive valuations like NVIDIA and all that right now and saying, oh, I want to go buy that. Who knows if that's going to work out? When I talk about investing in AI, isn't really just investing in stocks or any individual company or data centers or whatever. It's about understanding the second and third order effects, energy demand, as I mentioned, data centers, productivity gains, labor displacement, capital flows, and how blockchain and decentralized systems intersect with all of that. It is very, very complicated, but it's really important to start to try to understand. An experience has taught me is this: you don't need to be the first to invest, but you do need to be early in understanding. If you wait until something feels obvious, usually the opportunity is gone by then. And the thing about AI is, even if you think it's obvious now, the reality is that most people haven't really caught on. Maybe they played with ChatGPT, but I don't think they're understanding what this thing is going to do to our world. Anyway, so that is what this week's episode of Wealth Formula Podcast is about. It's about AI and also a little bit about, Bitcoin and blockchain and that kind of thing. We're going to talk about what's noise, what the long-term implications are of all of this stuff. This is a show that I really enjoy doing. Really, really good stuff. So make sure you listen in. We'll have that interview for you right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth, with more than 25 years of experience in capital markets. He's previously served as Chief Capital Market Strategist, Senior Portfolio Manager, Chief Economist, and CIO of equities at major investment firms, and has also taught economics and finance at the university level. Jim is known for translating complex economic, political, and market dynamics into clear, actionable insights to help investors and advisors navigate long-term capital decisions. Jim, welcome to the program.
Thanks for having me, Buck.
Well, Jim, I had been following a little bit of what you discuss on X, and one of the things that caught my eye is your narrative on AI. A lot of people tend to be still sort of skeptical of AI and what's going on with the markets, but at the same time, there's this sense, I think, that ignoring AI altogether as an investor is downright potentially dangerous. So, at the highest level, why is AI something people simply can't dismiss?
Well, we live in many other people have coined this term, but we're living in an exponential age of technological innovation. And, AI, and I'll just add into there, blockchain is just the normal evolutionary process that, for me started when I left graduate school and came into the business in the 90s, where everybody had this high degree of skepticism of the computer and the phone, and the internet. And so, what we do is we go through these cycles, and there are periods of time where the stars align, and we have a period of time where we have what I would call an intense period of innovation, where I would suggest to you that people are skeptical, and yet at the same point in time, they very early on in the trade call it a bubble when it's not. And so I think it comes from the position of ignorance. One, I think two, fear, and then three, if you think about if you are an active manager in a 40 Act fund, and you're sitting there with, NVIDIA at, 8 or 9% of your index. And that's a big chunk that you've got to put into your fund just to be market neutral. So there's a lot of people that hate this rally. There's a lot of people that are going to continue to hate this rally. But the thing I anchor my hat on are a couple of things. Look, if this is no different than the railroad, canals, any major technological innovation. Will it become a bubble? Yes. Just not now.
So let's follow up on that, because a lot of people are talking about the dot-com bubble comparisons, and you've argued that sort of misses the real story. So where are we getting it wrong right now? Are those people getting it wrong?
In the 90s, Buck, you'd walk into a bar and there wouldn't be ESPN on, there'd be CNBC on. People were quitting their jobs to become day traders. Folks didn't go to university because they were basically getting their white papers financed. You had companies that were trading off of clicks. So I lived that. Anybody who is of a younger generation has no idea what a bubble is. And it's specious and pedantic for them to use that term when they have no clue about what they're talking about.
But you did mention that it could become a bubble. How do we know when it does become a bubble?
Oh, it'll become a bubble. Well, when what I'm looking for is, when the good investment opportunities start to dry up, when liquidity starts to dry up. And so it's not about valuation. To me, it's about liquidity. So in 2000, and I'm roughly speaking, what went down was you had all these companies that were trading at catastrophic valuations, just stupid valuations. And you walked in one day and they didn't get financing. And if you read the prospectus or you followed the company, you knew that they were not going to be free cash flow positive for another 2 or 3 rounds of financing. All of a sudden you walked in and everybody goes, oh my God, this thing, trading at 250 times sales. And everybody went, yeah, of course. And so what it was when does liquidity dry up? So I'll give you a date. With Trump's big, beautiful bill act, 100% tax deductibility of CapEx. And that goes until Jan 1, 2031. So to me, that's a very motivating factor for people to invest. The last thing I would say to you in more of a game theoretic context, Buck, is look, if you're a big tech company and you don't invest in AI, you are insuring your death. Yahoo, Hewlett Packard. I can go through the list of companies that ceased to invest. So they're looking, if it was you and I and we were running this company, I would say, dude, we got to invest, because if we don't have a pole position in this next platform, whatever it is, we're done. We're toast. And I think that's why you're seeing all these hyperscalers spending as much money as they are, because they get this. They saw it.
So, you framed AI not necessarily as a tech trade, but as a capital expenditure cycle. Can you explain that to people?
Well, what we need to do is we need to build out the infrastructure of AI. And that's the phase that we're in right now. So it's more like we're building out all of the railroads, the railway tracks, and the railway stations across the United States back in the 1800s. And then we're going to go through that building phase. And then as that building phase goes, some companies, some towns are going to basically realize and recognize what's happening and start to basically take AI and bring it into their business model and to enhance margins, right? So right now we're building it out. I mean, we all focus on the hyperscalers, but the majority of companies, governments, individuals, they haven't used AI. And what is interesting about this is back in the 90s, they were talking about how the internet had to evolve to be much more, have critical thinking in it. And it was more explained when you went to these conferences is, think about this. You're hearing this in 99. Okay. Not today. You go in and you ask Google or Dogpile at the same time or Excite. Okay. You would say, I want to go to Florida in the third week of March and I want to stay here and I want to spend this amount of money and I want to rent a car. Plan it for me. And they would come back and they would tell you that you would come back and everything would be there. And you would have your over here and all you would have to do was drop your money and you had your thing planned. So none of this is it's aspirational, but we've heard it before. And in technology, what happens is it's not like it's new. We've been talking to, I did machine learning in graduate school. Right? AI, I did neural networks and I'm a terrible mathematician. This isn't new, dude. Claude Shannon wrote about this in 1937, right? But it's about when does it hit? So it was ChatGPT. Can we argue, was that right? As an investor, it's stop arguing, start investing. And then what you've got to figure out, which is the question you ask, is when does the music stop? I think it goes until the end of the decade.
One of the things that is interesting about this AI investment, it's unfolding in a higher interest rate environment. Why is that detail so important to understanding its significance?
Well, it's the cost of capital, right? And so this phase that we have right now, it's funny you say that, right? Because our reference point is zero interest rates, right?
Yeah, right, right.
So, so think about this, what it happens right now. Now we're in the phase where you've got these hyperscalers that instead of taking all their free cash flow and buying bonds and buying back stock are increasing CapEx because there's a great tax deduction on it. So you get so we're in this phase where a lot of the money is, let me be clear, was under free cash flow. Now we're getting these companies like Oracle and what have you, starting to issue debt. And look, debt isn't bad as long as the rate of return on debt is higher than the interest rates. And so, I would say historically speaking, for a lot of these high quality names, the interest rates are not at levels that will stop them from investing.
Right. You've written that productivity is ultimately the real story behind AI. So why does productivity matter more than the technology headlines themselves?
Well, let me just put it this way, right? So we've grown. I grew up. I'm up here in Toronto, right? So I'm going to give it to you in Canadian dollars, right? So I joined here. I grew up here, went to the States, came back home, growing this company. I joined when we were about $3.5 billion. We're getting close to $50 billion. And we're the fastest growing independent platform in the country. I'm a one-man band, right? I use 3 AIs. In the old days, I'd have 4 research assistants. Where's the margin in that? And so that's how I see it. And let me be clear. It's not perfect. But if I wanted to say, instead of you, but hey, write me a 2,000 word essay on the counterfactual of what happened with railroads up until 1894 when the bubble popped. Give me a 1,000 word essay and just a general overview. I can get that in less than 5 minutes. Right? Michael Saylor is writing product on AI, which it would take. He's in his presentation say it would take 100 lawyers. So it's going to be more about those, and it's no different than Internet of Things, or it was Kasparov that talked about that. Gary Kasparov talking about the melding of technology and humans. He would run this chess tournament called Freestyle, and you could use a computer, you could use grandmasters, you could use whatever you wanted to compete. And who won? Well, who won? It was those teams that were generalists that had a little bit of the knowledge of the computer and the knowledge of the tests of chess, right? That's what's going to happen. So this isn't, as far as I'm concerned, we're not, yes, there's going to be some jobs that are going to be replaced, but that is always the case in technology. I'm not a Luddite, okay? I am not a Luddite. But at the same point in time, I would suggest to you that it's just for me, helps me do research. no different than when I was an undergrad and they went from cue cards in the library at the university to actually having a dummy terminal and I could ask questions in queue. It stopped me from having to go to the basement of the library and go into microfiches, right? It's helping that way. Now, will it do other things? I'm sure it is, and I'll leave that to Elon Musk and the crew. That's above my pay grade. But for me, I see it as a very helpful way of, allowing me to process and delineate much more information and not have me waste so much time trying to figure out what went on in the past or, queue them up, right? Summarize me the top 5, academic papers in this area. What are they saying? And then they give me the papers, right? It just speeds the process up.
Yeah. One of the things that I've been sort of talking about and thinking about is that it's hard to not see AI as a very, very strong deflationary force. How do you think about that?
Technology is deflationary, right? No doubt about it. And so I look at it this way, right? So I work in the financial services industry. Okay. Mr. Diamond of JP Morgan is talking about how they are starting to embrace blockchain and AI. They are going to cut out the back end of that. The margins in that company by the end of the cycle are going to be fantastic. People just do not get in, the financial services industry is built on a platform of the 1960s, dude. I mean, they're still running Fortran, COBOL. So, how I look at this is much more as a margin type story. And there's going to be a lot of displacement. But at the same point in time, I look at Tesla and automation and AI. And, people look at Tesla as a car company. I look at Tesla as an advanced manufacturing company. Elon Musk could basically go into any industry and disrupt it if it wanted to, right? So that's how I look at it. And so, the hard part is going to be, nothing, if we get back to where we were, it's not going to be perfect, right? Because here's where the counter is. Here's where the counter is, right? If you think about, and I'm going to take Trump out of the equation and Bessent out of the equation right now. But if we just went back to the way things were before COVID, we would have strong deflationary forces. Okay. Just with demographics, just with excessive levels of debt, just with, pushing on a string in terms of we couldn't get the growth up, and the overregulation of financial institutions. Trump and Bessent are basically applying what's called supply side economics, and they're deregulating. It's Say's law, which is John Baptiste that says basically supply creates its own demand, and it's non-inflationary. But really what they're going to try to do is they're going to try to run the economy hot, and they're going to try to pull this way out of the debt. And if you do that and you deregulate the banks and allow the banks to get back to where they were before the financial crisis, okay? And the Fed takes its interest rates down to neutral, expands the balance sheet, then I don't think we're going to go back to the zero bound in deflation. I think this thing's going to run hot for a long time. And I think the real question is 275 in the United States the neutral rate? I think it is. But as Scott Bessent says, and let's be clear, Buck, the guy's a superstar. Okay. Guy is a legend. You sit there, just shut up and listen to him. Okay. They keep up. Right. Well, so they're going to run it hot, but where we are is, in his words, not mine. We're still in this detox period. You know what I mean? We still got the Biden era. We still got, a decade of excessive central bank intermediation that needs to go away. So what I say and what I've been writing about is 26 is going to be the year that the baton is passed back to the private sector. Let's get rates down to 275. I'm going off the New York Fed model that says real Fed funds, the real neutral rate is 75 to 78 basis points. I think inflation's at 2. That gets you 275. Get the rates there, and then get the balance sheet of the Fed to the level so that overnight lending isn't loose or tight. It's just normal. And then step back, go away, and let Wall Street and the private sector create credit, create economic growth, and let's get back to the business cycle. And if we do that, we're going to have non-inflationary growth. It's going to be strong, but we're not going back to the zero bound, and we're going to grow our way out of this. And so that's where I get really excited about this. Is a very unique time in history, right? A very, very, very unique time in history and I don't know how long it's going to last because of the compression that we have now because of we live in such a digital world. But let's say it's 5 years. Demographics says it's to 32 to 33, right? That's how long this run is. And to me, AI is a massive play. To me, blockchain is a massive play. And to me, it's to those countries and companies that get it, is whereas investors, we want to start thinking about investing.
Yeah. You mentioned non-inflationary growth. Can you drill down on that a little bit, just so people understand a little bit where, usually you think of an economy running super hot, you think automatically there's an inflationary growth. So
I want you to think in your mind, and to your listeners, think in your mind, go back to Economics 101 with the demand curve and the supply curve. Okay? And they're in equilibrium, and at that equilibrium, we have a price at an equilibrium and we have an output as an equilibrium. Okay? Now what I want you to do is I want you to keep the demand curve stagnant or anchored, and then I want you to shift the supply curve out. Prices go down, output goes out. We can talk all this esoteric stuff, Ronald Reagan and Robert Mundell and supply side economics, but it's really you're shifting the supply curve out. And that's what Bassent's doing. I mean, this is if everybody would just sit down and be quiet. He's talking about, what is deregulation, right? He's pushing the supply curve out. Oh, hold on, my phone, my thing. And what did, since the 2000s, what was the policy? It was Keynesian. It was all focused on the demand curve. Everything was focused on demand. And so all we're doing is we're getting the Keynesians out. I use 2000 because that's when Ben Bernanke really came in and was very influential. And let me just say, he's a very smart, I learned so much from reading, smart guy. But his whole thing was Keynesian. He came from MIT. His thesis supervisor was Stanley Fischer, right? We're going back to, Mario Draghi's thesis supervisor, Stanley Fischer. All these guys came from MIT. Larry's MIT, Yale, and Princeton. Whereas previously, it was the University of Chicago, right? It was Milton Friedman. It was supply side economics. They're going back to supply side economics. And right now we need it. We need balance. But my God, what did we end off with? We ended off with 4 years of modern monetary theory. Deficits matter. That's insanity.
You had mentioned a little bit, you've talked about blockchain a few times here. Talk about the significance. I mean, it's sort of, blockchain was a thing that everybody was talking about it, 3-4 years ago, but now it's all about AI. But, now you've got, but in the background, blockchain has grown, adoption has grown. Tell us what's going on there, and if you could tie it into the significance of where we're at today.
Yeah, Jeff Bezos gave a wonderful speech, I think, in early 2000s, where he basically talked about the fact that, once this innovation is genie's let out of the bottle, whether or not, Buck and Jim like it as an investment, the innovation continues. And so after the internet bubble popped, right, really smart guys like Jeff Bezos, Zuckerberg, the whole cast of characters, right, basically built it out. Okay. And it wasn't perfect. And everybody knew it wasn't perfect. I mean, that was the whole thing that was so bizarre, but they knew it wasn't perfect. And they knew that they needed to solve some problems, right? And, it was a double spend problem. I mean, the internet that we are dealing with right now was developed in the 1950s and so on and so forth. And so, that always stuck with me. Right. A couple of things stuck with me because I've lived through a couple of these cycles. The first one is, Buck, when Wall Street coalesces around something, just shut up and buy it. Right. I mean, I spent too much of my life arguing about whether Dogpile and Ask Jeeves was better than Google. Wall Street said Google was the best. Shut up. Invest. Right. And so look, blockchain solved the double spend problem. Blockchain solved all the problems that the original iteration of the internet couldn't solve, and everybody knew it was coming along. Okay, so it's decentralized, right? It does not need to be reconciled. So not only do you have another iteration of the internet, you have basically introduced into society the biggest innovation in accounting or record keeping since double entry bookkeeping accounting was introduced in Florence, Italy centuries ago by the Medicis. And Buck, all this is out there. So this isn't profound. So think about you're in an accounting department and you don't have to reconcile, right? So look, the first use case was Bitcoin. And what was the beautiful thing about it? Well, first off, it grew up by itself. And secondly, it's got perfect scarcity, right? And so let's just full stop. And I mean, yes, gold and silver had the run that they should have had decades ago. I had been waiting and listening to people, gold bugs, talking about this type of run since the 90s. Okay. But look, and the problem with fiat money, right? I mean, this goes back decades. It's an old argument. The way you solve it is Bitcoin. That's the solution. I mean, forget about it. I mean, if they're going to whip it around and do all this stuff, fine. But the other thing that people miss, and Saylor hasn't, and Saylor is brilliant, is look, Bitcoin is pristine collateral. In 2008, in September, what caused the system to stop was we could not identify counterparty risk for near cash instruments. It was a settlement problem. Anybody you talk to, Buck, that says it was, the subprime this and that was crap. I get that. But when the system shut down, is you had a $750 million near cash instrument with XYZ Wall Street firm, and you did this for 3 extra beeps, and it was no longer cash. And guess what? Your institutional money market fund broke the buck. That's when the system blew sky high. When the money market broke the buck, and it was a settlement problem. Blockchain and Bitcoin solved that. Saylor knows that. Look where Wall Street's going to go. They understand now that Bitcoin is pristine collateral and capital that is 100% transparent. Let's lend against it. And that's what Saylor's doing. That's why Wall Street hates the guy so much, right? Think about that. Think of it. Where is he going after? He's going after all the stranded capital on Wall Street, right? And the whole point is he's sitting there going, I'm too busy for this. And you've got all these other people that are going to live off of other people's ignorance Meanwhile, Jimmy Diamond knows exactly what he's talking about. We can identify. If I hear one more person on me in the meeting say, I don't know, MicroStrategy's balance sheet is so complicated. Really? Compared to JP Morgan's? I mean, you know what its capital is. It says Bitcoin. Like, what are you guys talking about? But hey, Buck, in this business, people make generational wealth on ignorance of people who think they know what they don't know.
So, just going back to Jamie Dimon, he spent, I don't know how long, throwing every insult he could towards Bitcoin. And now they've really they haven't backtracked. I think his I think the way he phrases is the blockchain's a real thing. He never seems to really say the word Bitcoin in this regard. Banks in general, where do you think they're headed with this stuff? I mean, right now, again, you can kind of see even, I think, some of the big advisory firms suddenly recommending 1 to 4% of people's portfolios in Bitcoin. I mean, this is all, gosh, I've been talking about Bitcoin since 2017. This is an unbelievable transformation in less than a decade. Where do you see this going in the next 5 to 10 years?
It's called what is it? I'm going to call it the evolution of Jim, right? Me, in my business. And the thing I have, Buck, is I've survived and I've gone through a lot of cycles. I've done a lot, and you ask yourself, you scratch your head a lot, but you're continually doing objective research, and this is why I love this game so much, right? So let's just stop for a second. Let's get some context, right? One of my first summer jobs, I worked in the basement of a bank in downtown Toronto, right up the street from the Toronto Stock Exchange. And my job was to let guys in with big briefcases into the cage, into the big vault, to basically bring in certificates. Okay. And what stock certificates. And so remember, and I remember my grandfather when he died, we couldn't sell the house because he didn't believe in the banks, and we were finding certificates all over the house in the walls. Okay. Right. So in the 1960s, it was bearer base. The whole industry was bearer base. And the volume in Wall Street started to pick up to the point where they couldn't handle the volume. And there was a paper crisis where almost a third of the companies went down bankrupt because of the cage. Okay. So basically what happened was, to make a long story short, they came out, hey, why don't we get 2 computers? At one point in time, they said, okay, crisis, let's solve it. Well, why don't we get these 2 computers and we can settle trades amongst each other. Okay. And then we don't need to have guys riding around Wall Street with bicycles and big briefcases. Okay. And then what we did was we sat there and said, well, why don't we have a centralized clearing, and we're going to call it DTC or CDS, depending on what country you're in. And what we're going to do is we're going to offer paper. We're going to issue paper rights to the underlying stock. That was developed in the early 1970s. That's the system that we're on right now. There are a lot of faults with that. Let me give you, when you talk about the GameStop AMC situation, when you have a company that's basically have more shares short than outstanding, that shows you that the old system doesn't work. It's called hypothecation. The paper rights to the underlying assets, it doesn't match up. There have been guys that make a career out of this and write books about this, right? Dole Pineapple. They had a corporate event, right? A hostile takeover. 64,000 for 64 million shares voted, I think, and there was only 32 underlying. We all know this. So this has to be solved. And the way you solve it is you tokenize assets. And this was talked about a decade ago. And they know about it. And true to form, and if you're thinking about it, it's totally logical, right? But if we allow this innovation to go full stream ahead, we're wiped out, right? So what did they do? They delayed. And as you know, you could talk about it's called Operation Choke Point 2.0, right? The Fed overreached their bounds. They debanked people. I mean, this is why Bessett's going after them. They stepped over their constitutional mandate, right? The Fed Act does not supersede the U.S. Constitution. Elizabeth Warren, the whole thing, they did it. Okay, so let's not complain about it. So now Atkins we're going to have the Clarity Act come out, and they're going to basically deregulate. New York Stock Exchange already there. They're going to put everything on the blockchain. And when you put everything on the blockchain, trade is settlement. There's no hypothecation. Immediate settlement, which is a benefit if you can get your act together, because for Wall Street firms, you need less capital, right? So it's a natural evolutionary process. And then you sit there and go back in history. If you and I were writing it, we'd sit there and go, well, should we be surprised that the incumbents, right, the status quo, pushed back on innovation? No. There was a prof at Harvard. His name was Clay Christensen, and he wrote this wonderful book called The Innovator's Dilemma. Why don't companies evolve, or why do they go bankrupt? It's because they cease to evolve, and the status quo doesn't allow the evolution of the company to take place, right? Well, that's what happened in our age. We're going to complain about it? No. It is what it is. It's water under the bridge. And so what I think is happening is, Mr. Diamond is basically saying, he's pragmatic. He's a realist. And now he's saying we got to evolve. And hey, by the way, now I've got to the point where I think I can make a ton of, think about
his own stable coins, right? So his own stable coins. And,
well, think about this. If you trade like internal meetings, right? And this is hypothetical, right? I go, Buck, don't screw this up this time. And you're going to go, Jim, what are you talking about? I go, we want a nice spread between bid and ask in these financial price. We don't want to go down to pennies. Okay. Can we go back to the old days when we were, trading in quarters and sixteenths, and so we can make some skin in the game? And then you've got the deregulation of the banking industry, where the banks are going to, it's going to be baby steps. But what's going to happen is they're going to basically say, stop taking all that capital that's sitting at the Fed, making Fed funds rate overnights, wherever it is, 4.5, 3.75 right now. And you can now trade it, go back to prop trading, which is what they did. And they will start off with its only treasuries. Eventually they'll be able to expand throughout our lifetime. So the old way you got to look at it is, we're bringing the band, putting the band back together, man. Right. And the banks are going to deregulate. They're going to deregulate the banks. They're going to innovate. They're going to be able to use the capital. Their earnings profile going out into the end of the decade, it's going to be monstrous. It's going to be, and that's how I get, when people say, where do you think the S&P goes? I say, 14,000, double from here by the end of the decade. And he goes, well, what about AI? I go, well, that's important, but it's the banks. I think the banks are going to have a renaissance.
Yeah. One thing, just to get your thoughts on, so when you look at the banks, you talked about sort of the inevitability of tokenization, the stock exchange. We talked about stable coins. I mean, another great way for banks to make money, essentially. Where does that, how does that help or hurt Bitcoin adoption? Because Bitcoin is a separate. You're not building on Bitcoin as much as you are, say, Ethereum or Solana, or some of the blockchain things. So is it just an adoption issue because you live in a different world? You live in a world of blockchain and Bitcoin is its currency.
It's weird, right? Because I'm writing this feed Buck, where are you right now? Where are you located?
I'm in Santa Barbara.
You're in
California.
Okay, so
yeah.
So I'm in Toronto, right? I worked in the States for a couple of decades, and I'm back home, and it's like, man, they don't get it up here, right? And what am I talking about? Well, this is the thing that you've got to understand is this, right? Ethereum was invented by Vladimir Buterin in this town. Joe Bellozo, who's the head of one of the largest Ethereum groups, father is a dentist at Bathurst and Spadina. And so we're up here and people are saying, oh, President Trump, don't talk about being a 51st state. We act like a colony, dude. We are, we forget about calling us one. We are. So look, there is no doubt in my mind that Ethereum is going to have a place, and we're going to use. It seems like we're going to use Ethereum, and that's the smart contract, and that's fine. But going back in time, but remember, there's not perfect scarcity there. So I like Ethereum. Don't get me wrong, but I look at Bitcoin and I look at the scarcity, and I also look at the fact of what Saylor. Saylor did a presentation in the middle of next year, and all hell broke loose. And what he did, and it's and of course I'm hypothesizing. He basically went to New York and said, I am going to create fixed income products and I am going to give yields on those products. And I'm coming after the stranded capital that sits on Wall Street that you guys have been ripping on for years. In the middle of last year, Saylor went public and declared war. Okay. Are we surprised that Jim Shane Oaks came out and everybody came out basically guns a-blazing? Are we surprised? But what Saylor did and put and slammed on the table is it's pristine capital. It's transparent capital. And what are you willing to pay for that? And now you've got banks trading at, when we have no idea what their capital structure really is, honestly. We have an idea, but it's very opaque, right? The high quality names are trading at two times tangible book. You've got fintech companies trading at 4 to 5 times, right? Book. And what's Saylor doing right now? He's diluting his stock so he can buy as much Bitcoin as he wants because he sees the next game. And he says, the hell with what you guys think. The next game is going to be Wall Street's going to realize that Bitcoin is pristine capital and there's only 21 million of it. And what just happened today, Buck? What did Morgan Stanley just file? A treasury company. So everything you and I are talking about, they know. They're smart guys, right? They're not, this is the whole point. They're really, really, really smart. Okay. They've gone through the history, right? They know, okay, so you're sitting there, you get around the room, you say, so wait a minute, Saylor's over here, and he's basically saying he can give you a pref that's basically backed by Bitcoin, charging 10%, and he's going after our corporate clients. I mean, and what's the pitch? Buck, you've got $100 million, okay? You got $100 million in the kitty, okay, Buck? And what happens is you need $10 million a year for working capital, which is in cash, which means you've got $90 million sitting there idle. Hey, Buck, I can give you 10% on that. You go to Jamie, he's giving you 2. What are you going to do?
Yeah, I think one of the issues right now is the perceived risk profile of that, right? I tend to agree with you about the pristine nature of Bitcoin as collateral, but just in general, the perception, I don't know that's the case.
Well, you got to go back to the fact that, do you think Bitcoin's going to zero or not?
No, of course not.
Because if Bitcoin doesn't go to zero, there's no, then that are, Bitcoin could go to zero. There's no, I don't think, non-zero probability, of course, right? I don't think it is. And if it has been selected and now you have Wall Street coalescing it, I haven't even mentioned the president of the United States or his family, right? Or the Commerce Secretary and his family, right? Or if you go to New York, Wall Street, right? They're all talking about it, right? So to me, the question about MicroStrategy, to me, It's not that it's a treasury company and it's got a pile of Bitcoin. What does he do with it? Does he become a bank? Like, why doesn't, this is me, I'm pitching him, right? Hey, Mike, why don't you just become a fintech? Say you're like a fintech company and you're going to instantaneously trade at 5 to 6 times book. You're talking like you're attacking them, but you're still a software company with a big whack of Bitcoin that you are writing prefs. Right. So, and so that's how I look at it. I think the wave is too big. We are going to digitize. And the other thing that we didn't really touch on with respect to AI and blockchain, and I'm going to paraphrase the president, right? Mr. Trump, is look, it's a matter of national security, dude. And when I hear that, I go back to the 90s. In the 80s, late 80s when I was an undergrad, right? And it wasn't China, it was Japan. And what happened was, it's funny. Al Gore did deregulate so that the internet could become for profit. We all stood around and said, what the hell? How do we make money on this? That's, what do we do? And then what did we do? We threw a ton of money at it, and the United States controlled it. And what did we get out of it? We got all those companies, right? The last thing I would say to you, and this is much more of a personal story, is when I was younger, I was in New York, and it was 2000, and I was at the Grand Hyatt, and it was a tech conference. And Larry Ellison of Oracle was there, and he gave a fireside chat. And then we go to a breakout room, and in a break, I don't know about if you've been to one, but you go to a breakout room. It's a smaller room at the hotel, and sometimes you got 25 people, sometimes you got 50 people, right? And I went to the breakout with Mr. Ellison because of Oracle, and I went in there, and it was absolutely jammed, and I was sweating, and he just looked at us. And he just ripped us. He absolutely I still have the scars today. I'm talking to you about it. Okay. He called it a bubble. He was early in calling it a bubble. I never forgot that. And then you sit there and see what he's doing right now, where he's levering up the balance sheet. Now, to me, having survived in this game for such a long period of time, and I call it a game, it's a game of strategy, whatever, how does that not, I would say to you, your office was next to mine. Buck, I remember New York, he's loading, the dude's loaded in. He's going in, he's borrowing money from his grandmother. He's, what is going on? And he's really stinking smart. Larry Ellison just doesn't do, and people, he's not. He's like the mentor of all of these guys. You know what I mean? So there's a discontinuity that leads me to believe that we're still early on. Because you know what? What do we take when Larry or Mr. Ellison is leveraging up? To me, it's profound. Because I'm anchoring off of my bias to the New York High at the tech con. I think it was either Bear Stearns. I couldn't remember Bear Stearns or Lehman, but one of those. I carry that experience on with the rest of my life. I do. It's like, what is Larry thinking? Right? So he's leveraging up, Buck. That's all I know. He's a pretty smart guy.
Well, that's probably a good place for us to stop. Jim, Chief Market Strategist at Wellington Altus Private Wealth. Thank you so much for joining me.
Thanks so much, and be safe.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. Meanwhile, you've got a mortgage, or private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. As I said before, do not ignore AI. This is something that you need to start using, have your kids start using it. Make sure that they use it every day, because this whole world is turning AI, and it's going to happen. It's going to happen in a blink of an eye, and the world is going to change. And there are going to be real winners out there. And the winners are going to be people who knew where this was going and kind of used it in their mind's eye as they looked on navigating how to allocate their money. Anyway, that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing out. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.